You're listening to the RE Social Podcast with your hosts, Andrew and Vince from OnV Invest. For more information, go to onvinvest.com.
What's up, you guys? Welcome to another episode of RE Social Podcast. Today, we have Sam Hales from Saratoga Group. How are you, man?
Doing great, Vince, Andrew. Happy to be here with you guys.
Yeah, man. So for listeners who don't know what you do, I know you got like 300 millions in assets and stuff. Can you give them a little intro about yourself?
Yeah, happy to do it. So I think a lot of people started out doing single family. Actually, maybe I should back up. I was in tech in the Bay Area, San Francisco Bay Area. Started doing a little single family on the side. Turned that into full-time about 12 years ago. I actually raised a fund, and we were buying single-family homes in Oakland and other areas around San Francisco Bay Area. Did that for a few years, and then was looking to do something a little more efficient, I guess, from my perspective. So bought our first mobile home park in 2017, and within a couple months of owning that, decided this is what I've been looking for. And so kind of went all in on that. And we've been buying and operating, fixing up, building mobile home parks since 2017. We typical year is we'll buy about 1,000 units. And so we're at about 7,000 pads right now. And it's been a little slower lately with acquisitions, but it looks like it's about to pick up. So kind of excited about what the future brings there.
That's cool, man. So when you started buying in Oakland, which has like the worst eviction laws in the history of the world.
That's literally what I was going to talk about.
Yeah.
Hey, tell me about Oakland.
How did you get into that? Like, did you just have money to buy like 1,000 units? Or how far did you get with single families before you moved?
Yeah. So like I said, I started off doing a little bit myself, and then in business school, one of my classmates is from China and had a Chinese company, a big multinational in China that wanted to place money in the U.S. Mm-hmm. So we started a fund, and that was in 2012 that we launched the fund. But no, you're right. I mean, I didn't go into all the reasons, but between the move from single family homes to mobile home parks wasn't only that, it was also moved from like the West Coast, mostly California, to Southeast and Georgia and Tennessee and Alabama and Florida and in the Midwest as well. So we're in 17 different states, and not California. Well, at least not mobile home parks at this point.
Why not?
Because of just some of the rent laws, and we could kind of see where it was headed a little bit. And of course, then COVID hit, and it really got nuts with landlord laws there in California. So we migrated to just states that are easier to operate a business in, which is also why we moved the company to Tennessee.
How far did you get with the funds for the single families in Oakland before you moved on?
Like how much money?
Yeah. Mm-hmm.
So we raised about $25 million for single family homes.
How did two guys from college who know nothing about real estate raise $25 million from China? Like, that sounds crazy.
Well, okay, yeah, sorry, that was graduate school. So okay. I'd been in tech for 12 years at that point. And my business partner had done a bunch of real estate projects as well. So we were actually, he had kind of had a little more institutional experience. I was more just, grinding it, fix and flip sort of stuff. But yeah, and of course, like most things, it was knowing people, and he had that connection.
Oh, so you already had fix and flip experience by the time you were graduating from graduate school?
Yeah.
Okay.
I'd already done that.
Did you own any real estate at that point, or are you just doing fix and flips?
No, I had. I'd have to think back, but yeah, I had a few single family rentals at that point. So, a little bit. little bit of experience.
Okay, sounds good. So you had some experience with that, and he had some experience with the tech. So you were able to, obviously, you knew all the docs and stuff to get the funds going. So I assume this was all accredited investors, so they don't care if it's international.
Well, so in that case, it was actually just this large corporation. It wasn't a group of accredited investors. So yeah, but we had we spent a lot of money on our legal docs for putting that together with the multinational and all of that. But yeah, that part of the model's changed as well. Now we also raise money mostly from high net worth accredited investors. So we've got like 450 investors spread across the funds that we have.
So my question is, so you had the funds now from that big company, and then you were buying in Oakland. And what made you decide? I know you briefly mentioned you're trying to go to the Southeast, did you look up demographics? Are you looking up businesses? Or are you just looking up squatter rights? Like, what was about the blue state that you were trying to get out?
Yeah, so really it started with this transition from single family homes into mobile home parks. So the first mobile home park we bought was there in California, 30 minutes from my house. Like anything, it's like, well, shoot, it's gonna be a lot easier if I can do this close by and kind of figure it out. So once we figured out, yeah, this is what we think it is, and we want to buy more mobile home parks, that's when I started looking at, okay, where's the opportunity? And actually, so some of that was related to the landlord tenant law, but a lot of it was also looking at the disparity between what a regular rental, let's say just a 3-bedroom apartment, might rent for versus what the lot rent was at a typical mobile home park. And what we found is in the Southeast, those lot rents were very depressed. So our business, most of the communities that we've purchased in the Southeast, when we bought them, the lot rents were $200. Now, that's a round number. I mean, sometimes it's $250, sometimes it's $150. But it should be relative to like demographics and, kind of median income, median home price, median rent. Those lot rents should be more in the 400 to almost 500 range now. Mm-hmm. And so that was kind of the big thing for us. We're like, well, look, these should be more. And there were some reasons for that. Like a lot of the communities, they were, I'm going to say trailer parks, right? They're just not very nice and they needed to be cleaned up and there needed to be capital put into them and that sort of thing. But we found that once we do that, there's really almost insatiable demand for the product.
Once you clean it up, put some money into it.
Yeah. Once you clean it up. Yeah. And basically, show, because it's interesting in the mobile home park business, and I don't know how familiar you or your guests might be with mobile home park investment, but basically you've kind of got symbiotic, although it can be adversarial, but symbiotic relationship with your residents, because basically, you want them to own their home. That's the best model. And so typically they do own their home. Of course, you own the land, they're leasing it from you, but they've made an investment into their home. And people are not going to want to buy a home in your community or even stay in your community if you're not investing into the community. What happens is we would come in and we would raise a rent, but we're cleaning up the property, we're repaving the roads, we're putting solar street lights in, kids' playground, a few other things. And when they see that creates value for them, because now their house, if they go to sell it or whatever, it's going to be way easier to sell it, and they're going to sell it for a lot more money than when it looked trashy before. So it's kind of this interesting relationship. So we do raise rents, but we raise them responsibly, and people, we don't have a problem with that when they see what we're doing to make the property better and really to make their community better, make better lifestyle for them. So.
Do you lead first with that value up front and then say, hey, we're going to increase your lot fee because we're doing all these, things, or is it the other way? Does it just depend on the situation?
It's a little bit dependent. Like we'll here's ideally, here's what happens. And this is what happens in most cases is within the first 30 to 60 days, we're going to try to do some sort of big CapEx project. The easiest thing to do is trees. So a lot of times you don't really think about, I didn't think about this before I got in the business, but a mobile home park to have, let's say 100 units versus an apartment complex, you're going to be really spread out, right? Because you're not going vertical and it's not super dense. And so you're going to have a lot of property and there's going to be a lot of trees. So, I mean, these communities, when we're buying them from mom and pop, they haven't reinvested into them. One of the biggest things is there's just like trees that are overgrown or dead or need to be trimmed up. And we'll spend $100,000 kind of right off the bat to get the trees cleaned up. And that kind of signals to people like, okay, this is going to be different. Like they are actually going to invest into our community. So that way, when we do issue the rent increase, they understand that they're getting something for that. It's not just extracting from them.
Yeah.
If that makes sense.
The power of curb appeal is, wow. I underestimated it. Most of our career, it's like, yeah, it matters. Trim up the trees, clean up the lot. It looks, it's just a whole different game.
Yeah. Yeah.
That's smart. So you're leading with the value first, bring the rents up. And yeah, that's great. How do you make that transition from, I kind of like to go all the way back. I'm a history buff. So I love to know like how you work and what your brain and relationships. And did you have an uncle? How did you go from, doing what you're, let's just say the 9 to 5 into real estate? Like, what was that, Rich? How'd that happen?
Yeah. You guys have read Rich Dad, Poor Dad, right?
Yeah.
So, and no offense to my own dad, he's poor dad, like orthopedic surgeon, all the rest, straight from the book. And I got out of college and I actually saved up some money and I had money to buy a house. When I told my dad I was planning to buy a house after graduating from college, he's like, don't do it. He's like, I've lost money every time I bought a house. Like it's a terrible investment. Like really tried to talk me out of buying my first house. And I'm like, well, I'm going to do it differently. Like I'm going to buy something where my wife and we're going to go fix it up. Right. We're going to roll up the sleeves. And that's what we did. And we bought this house and we tore up the old carpets and refinished the wood floors and just swinging a hammer kind of after work and on the weekends. And I loved it. And we got to the end of it. And of course, we had an appreciating market. So it made everything look a lot better than maybe just the sweat equity. But when we realized like how well we'd done on that house, just, we hadn't sold it yet or anything, but just the value that it created. That's when I got the bug and started to look around and start, saving up some money to go do a flip here or do, we did a lot of lease options as well, where we'd buy it and then we'd do a lease with an option to buy. So anyway, that's nice. That's where it started.
Nice. So you read that book, probably a handful of others.
Yeah.
Got some tools and some information and just took a chance on a house. Sounds like you didn't make a lot of mistakes. Sounds like you had some pretty big wins and that was the momentum to keep it going to the next level.
Oh, I had lots of mistakes. So yeah, and that's the thing. You're right. It was probably relatively lucky on the front end, especially with the market. But even at that point, without knowing very much, I seem to at least understand, hey, we can kind of force equity here or force some value by being willing to do some hard things. And I would say that's a principle that I've carried with me. So even when we've screwed up and made some dumb, buys or dumb mistakes, I've usually, I've been able to kind of, work my way out of that by being willing to like really roll up the sleeves and do whatever I had to make it work out and get it figured out.
I love that. So, that's kind of what happened with us with our first property. Really? We made some pretty critical mistakes from the area to, not vetting the tenants well enough and et cetera, et cetera. But yeah, the reason why I think, at least for me, why I had the confidence to just take literally all of my savings and put it into this thing and hope for the best, was because I knew that I could rely on myself, and I could, if I had to, like literally roll up the sleeves and build a fence, paint walls, and lead the team, which is a lot of what I did. Because I was cash poor and I had to, you know.
That's right. You didn't have a choice, right? Like that you had to, because you didn't have anything else, and you weren't gonna lose, right? You were like determined to make it work.
Exactly it. And I think that's, you know, where I think a lot of people stall is they're afraid. You know, we're more averse to taking a risk and having a loss than a potential gain. And so for me, I just knew like, all right, I'm going to give this a shot. This is the path I want to go down. But granted, I had a lot of leverage. I really want like financial freedom. I want to be able to take my mom to Spain. I want to be able to just like, you know, because my family doesn't have a lot of personal finance. They're just not those people. So the point is I had a huge leverage. So I leveraged that emotionally, and I just went up, and I ended up having to do that. And I'm glad I did. I learned a lot. Definitely learned from our mistakes, and but we kept going forward. And so similar to yours, bringing it back to you, we did have appreciation on our side. So we did come out walking out pretty clean, with some hard lessons learned for sure.
Yeah. Oh, man. It's funny how similar probably so many of our stories are when it comes to that. But that's why we're sitting here talking about it and not moved on to the next job and working for somebody else, because we were resilient, right?
Yeah.
And just kind of powered through it. So
So that the learning lesson for anyone listening is just prepare to do the work, because you will make mistakes, and that's okay. Just be ready to roll up the sleeves and take care of it, and just trust yourself. Because I think people are way more powerful, can work harder, longer, and be, you know, I think just the potential is severely untapped with the majority of people. And it pains me because I see it every day. So back to you though, you went from doing this DIY style, and then the next phase of your journey was what?
Yeah, it really was. I mean, it sounds like probably a big step function, but it really had only done a handful of properties, went to business school. I went there with the full intention. I was very focused. Like I'm going to business school here so I can start a real estate fund. I had a lot of classmates, they were there like, well, I don't know, like sounded like a good idea. And maybe I'll do this, maybe I'll do that. Like everybody knew Sam's focus, like he wants to do a real estate fund. And so I was able, as I shared earlier, make that happen, coming out of school. So that was really kind of the next step after just doing, kind of a handful of fix and flip or single family investments.
So did you jump from, and correct me if I'm wrong, did you jump from just single families, fix and flips more or less, jumped right into these huge lots with like 100 plus, mobile homes?
No. So went from doing these single families to this 25 million that we raised for buying, single families on a bigger scale. So we ended up doing 150 homes or so in the greater San Francisco Bay Area. So did that for about 5 years, which took me to 2017. That's when I bought my first mobile home park.
Got it. And so my question is, because I don't know anything about mobile home parks besides a little bit what I've learned from some others that we've talked to. How did you decide on that particular investment vehicle? What was the most appealing factors? What were some of the pros and cons going into that?
Yeah, no, totally. I love talking about mobile home park investment. I think it's a critical need for affordable housing in our country, and there's also some really unique benefits to it. Funny enough, like at that point, 2017, I was concerned about a recession, and of course, we all know, man, that bull market had another 5-6 years in it. Who knew? I didn't know. I was like, man, because I was looking at what we used to buy them for in 2012 and 2011 versus 2017. There'd been a lot of appreciation. The multiples in terms of kind of cash on cash weren't really making that much sense in the single family world. So the number one thing that I was looking for was a relatively recession-resistant investment. And as I started searching around and then found out about mobile home parks, there's something I read, I can't really remember at this point. I heard that there's two publicly traded REITs. There's now four of them, but at the time, two big publicly traded REITs that are focused on manufactured housing. And at that point, they had been publicly listed for 16, 17 years. And what I was told is that every single quarter, they had reported same store NOI growth. In other words, you take one lot or one unit in that portfolio, every single quarter, it was generating more income. And that sounded astounding to me because when I thought about the last 16 or 17 years, it's like, okay, there was the dot-com bust, there was the Great Recession, there were other, just economic events. And to think that there was this real estate investment that had grown operating income every quarter. So I have a brother-in-law that works on Wall Street, and I was like, hey, I heard about this. Can you send me the financial data for the last, since these guys got listed? And he sent it to me and looked at it, and sure enough, it was true. And so I remember that was kind of a seminal moment for me. I was like, man, obviously you can't guarantee that's going to happen in the future, but the fact that that's happened over that long a period of time had me super interested. So that was the number one thing. I mean, I can tell you about some of the other advantages if you want, but I don't think I understood any of those at that point. That was really the thing that interested me the most was just kind of learning that.
Numbers and research and looking at the growth potential.
How do they value I have a small ownership in an apartment building too. Are we still looking at expense ratio and cap rates, or are we looking at like GRMs and stuff like hotels?
Yeah, it's definitely more like a multifamily apartment building.
Okay.
in terms of cap rates and expense ratios. And that would especially be true if it's a stabilized mobile home park. Mm-hmm. We tend to look at Saratoga Group because we buy unstabilized mobile home parks. I mean, like our average occupancy when we buy a park on average is something like 60%. So imagine buying an apartment building, there's 40% vacancy. It would be huge, right?
You won't even get a loan.
Wow.
Yeah, you wouldn't get a loan. Get a loan. And so those get valued a little bit differently. I mean, we're still looking at the cap rate, but you're also looking at, okay, how quickly could we infill this property? What's the value of those vacant pads? How much work needs to be done to them? Obviously, like we talked about, the capital improvements that are necessary. So we're kind of looking at some of those metrics even closer than necessarily what the going in cap rate is, especially as I mentioned, a lot of these communities, when we buy them, the rent is half of what the market is, that's another, right? I mean, that was another crazy, again, I didn't understand that at the time we got into it, but now that I've been into it, I'm like, there is no other commercial real estate where you can repeatedly buy property where the rent is half of what the market is. And we've done it. We've got 106 properties, and I'm trying to think of one where there isn't. I mean, none of them were at market when we bought them. Not a single one.
And that's, for anyone listening, why, especially if you're one of those crybabies that think that tax laws are things that rich people take advantage of, you are wrong. This is why, because guys like Sam are taking big risks, raising lots of capital, and improving communities, and promoting cleaner environments with better life for anyone who's involved. Are the rents going to go up a little bit? Lot fees, yeah, but I mean that's the way the world works. You want more value, you have to pay for it. It's just the way it is, and so that's why the tax incentives happen for guys like us, for Sam, especially because we're taking these big moves. We're creating industry. We're hiring tree trimmers right out the gate before we even have a check in our pocket. And that's, one of those things that people don't understand, that I want to stress, that the tax code is written and such to create incentive for guys like us. It's not the whole reason why we do it, of course, but it definitely doesn't hurt. So it must feel good to be able to do that, go and improve a community and help, create a better life and for these families that are there.
And we talked about kind of the reasons for it. I love that aspect of it. So like we have a company call every week, and it's 30 minutes. We try to keep it super brief, but we have 120 employees, and not all of them are on the call if they're in a
They're still on.
That's one of the things that I really love about the mobile home park business is just the difference that it makes, that you can make with really relatively small investment in the lives of a whole bunch of people, a whole bunch of families. So we have a call every week as a company, and it's 30 minutes. Pretty much everybody's on the call, and it's mostly a celebration. I mean, we go through the numbers and our KPIs, and we're looking at metrics and our move in and move out and all this stuff. But almost always there's some sort of celebration of, hey, look at what happened in this community. We just put in the kids park, or here's the new roads and the kids are out playing, or we put in this bus stop, and it's just kind of celebrating what I call those wins. I mean, like, we're not seeing the money from that yet. Like you said, Andrew, it's an investment. We're putting that money out there. But if we do that, we have seen it over and over and over. You're creating community. You're creating a place people want to be. The numbers take care of themselves.
Yep.
So we love just kind of celebrating and we've got managers that take so much initiative and are working with, think of a recent example of working with a local doctor to come in and give free health check for any of the kids that live in the community. And it's like, they just put this together. Nobody told them. Excuse me.
Awesome.
Nobody told them to do that. They felt empowered enough and recognized the need and felt like, hey, let's make this happen. And so it's just, I love that. Like, if I can spend my days just listening to the good things that are happening and the difference that people are making, that's my favorite part of it.
That's awesome. So I'm sure that we want to dive a little into the numbers, making a total shift. Vince, do you have questions about how numbers are working on that? And because I'm kind of curious too.
Yeah, man. So give us, when was the last deal you bought?
So we bought a deal 2 weeks ago.
Okay. Take us through that. So that'll be fresh off your mind. So give us like purchase price negotiation, purchase cap, what thing you're going to do, improvements, and how you're going to, compress the cap rate and all that.
Get nerdy is what he's asking.
Okay. We're about to geek out.
Okay.
Yeah.
Excuse me. This one's a little interesting because let me just paint the picture. This is in Greenville, North Carolina. This was our 13th park we bought in that market. It's our biggest market by far.
Hey, real quick, just before you start, do you know Jake and Gino?
I'm sorry, who?
You know Jake and Gino?
No.
They're apartment guys. They're also based out of Knoxville. They have millions of dollars of real estate there too.
Okay.
Yeah, cool.
We might need an intro. Yeah.
I can introduce you. Yeah. Okay. Italian guys,
awesome.
Cool guys.
Awesome. But anyway, so this was another park in Greenville. Greenville is just like what I was talking about. We typically buy stuff there, and rents are $250 or less. The market's $450. Cactus Lakes is 46 units. It has, but I think it's like 33 of them are occupied right now. So what does that turn out to be? Something around 65, 70%.
Yeah.
What's different and interesting? Purchase price is $1.15 million.
And what's the purchase NOI?
Purchase see, this is where.
Oh, I out-geeked you.
Well, no. Give me just a second here.
He's like, oh, wait a minute. Let me pull
get
up
my
spreadsheet.
Spreadsheets.
Yeah. Let me
We live for Excel.
Let me do this super fast.
Anytime you do an interview or a meeting or podcast with an Indian, make sure your spreadsheets are up to date.
That's true.
So we're in about $7,000 a month in NOI out of the gate. So that's 84,000 divided by 1,150,000. So that's like a 7.3 cap going in.
That's pretty good. Is that normal for is that expected for a mobile home park?
Have you thought about investing in real estate and taking advantage of all of those benefits without any of the work? That is something that OnV Invest not only provides, but has been providing since its inception. With friends and family, we have built an empire in a system of a wealth generating tool that is giving us and our friends and family that leverage in their life to create true wealth. Go to onvinvest.com for more to see if you qualify. And thanks for listening.
Is that normal for is that expected for a mobile home park?
Yes and no. Here, and I'll explain in just a second though. But
yeah,
that's on the rents that are half of market.
Oh hell yeah, that's good.
Yeah,
wow.
So that's why I'm saying, like, that's why I didn't really know that number offhand, because I'm like, I'm kind of thinking about, hey, here's where we are in 2 years or 3 years when we're at market and everything. As far as it being common, yes, I mean, typically you're gonna trade in the 6 to 9 range.
Mm-hmm. And what's the expense on this? Is it sub 50 or is it over 50?
It is around 40% expense ratio.
40% for that NOI they're bringing in? That's really, so it'll be nothing for you when you increase it.
Typically, when I see numbers this generous on paper, I always got to ask, because we've been burned on it before, what's this area like? Is mom able to move in? Like, are the tenants problem tenants? Is there drugs happening? Let's just get real. Like, what's going on?
Well, okay.
Does your mom like drugs though?
Who has the meth? Mom has the meth. No, but seriously though, I kind of want to know, like, what kind of areas are you working in? What?
So this, and we haven't even got to the business model on this one because it's actually a little different than most. But yeah, when you buy, euphemistically, when we buy a mobile home community that's 2/3 full and rents are half the market, there's problems. Like, I mean, we've had to get the FBI involved before. We definitely, local cops, a lot of turnover typically. We're definitely gonna have to do some of that here. So 6 months from now, the cap rate's probably 4 because we had to kick some people out. And before,
okay, you come in and you kind of start cleaning out the riffraff first, cleaning up trees. Riffraff is going. What's the next step there?
I'll tell you what's happening in this case. This one's interesting. So the name of the property is Cactus Lake, and it literally is on a lake in Greenville, North Carolina. We have found that there's not much long-term RV in that market. And because of where it's located, by right, we can turn every mobile home park lot into 2 to 3 RV lots. And by the way, RVs rent out for 500 to 600 a month. So basically what we're doing here is we're going to be transitioning folks out of the community. We have a lot of other mobile home parks, as I mentioned, in that market. We don't want to take affordable housing away. So we're going to offer them to move their home for free to one of our other communities as we build this and turn this into an RV resort.
Interesting. So is RV a bit more of like a, dare I say, short-term rental-esque kind of business model compared to a more stable, like, mobile home?
Yeah, it is. And it totally depends. You have kind of hospitality type RV parks that are exactly like a hotel, and you've got dedicated software with dynamic pricing, all the sort of things you'd see in the hotel industry. What we're talking about is more long-term RVs. So this is people that are have a travel trailer because they're a traveling nurse, or they're a contractor that has they're doing electric line work, and they 6 months here and they go 6 months somewhere else for another project. So there's really no supply of that in the Greenville market.
Interesting.
So that's the sort of clientele we're talking about there.
It's interesting that there's this RV aspect. So that's how little I know about it. So I don't know anything besides it's been a pretty big win for those who are willing to put their heart and dedicate their time to it, and of course run their numbers right. Vince, do you want to elaborate on where we were in that the purchase?
Yeah, we got purchase price 1.15. We got an NOI of 84, purchase cap 7. and expense ratio is 40%. So you're saying you're going to be moving people around. So your vacancy rate is probably going to go worse for the next 6 months, right?
Well, yeah. In this case, and actually, so what we're doing in this case is there's a section of the park that doesn't have any homes right now. So because there's kind of this unfilled demand in the market for RV spaces, we're going to go ahead and here in the next few weeks, we're going to build out probably 15 to 20 RV spaces. And again, that means, 8 to maybe 12 mobile home park spaces, because we can get 2 for 1 or even a little better. So we're going to do that first. So actually, we're going to see, but this is a different business model. This isn't typically what we do. I'm just telling you about our most recent acquisition. So actually, we're not going to see the income drop much.
Okay.
We're going to see it go up before it goes down
because of the RV opportunity with this.
Because of the RV. Yeah. Otherwise, it would be more of, okay, here's Saratoga now owns this. Here's how you pay your rent. We don't tolerate this. We don't tolerate that. Right. I mean, we're going to invest in the community, but we're also going to be real forthright and strict about these are the rules. We're trying to make these communities friendly for families. And so anybody that's going to not be a good neighbor and not be a good citizen, basically, is not going to want to live in our park.
That's great. Yeah.
It sounds like, correct me if I'm wrong, you guys do most of the work in-house, like you're doing underwriting and up to all the way to acquisitions and property management. Are you guys fully vertically integrated?
Yeah, it's worse than that. It's
he does all the work.
When I say worse, it's like, man, I had no idea what I was getting into when we started. Yeah. Right. I mean, I guess it's like any of our journeys. We really, if we knew, sometimes we wasn't. Yeah, the NVIDIA CEO. I don't know if you heard that interview where he's like, when somebody asked him, they're like, well, your company is now like the 5th most valuable company in the world, and was it worth it? And he's like, no, I wouldn't do it again.
Yeah, he said that.
I feel a little bit the same way. It's like, man, oh my gosh, I had no idea. So yeah, we're doing everything in house. We underwrite all our own deals, source our own deals. We operate our own deals, and we have our own construction company. So we actually are building our own communities as well. We finished our first RV park it was in December, so 4 months ago, and we're doing another RV park right now, actually in Greenville, North Carolina, that we're just talking about. So we've had to just get super vertical, and mostly just because we're kind of in a niche industry in mobile home parks, so there's not really much third-party management available. There's when we go to get it's also very fragmented space. So we're in 17 different states. We're in all these different locations and MSAs. It's not like we have, hey, we're in Nashville and we've got our guy that does, whatever, asphalt or that we can use over and over and over again, and we build this relationship. No, it's like every time we have a big project, it's like, okay, nobody in that town knows who we are, probably. And so we've just found that in order to execute our business plan and get fair pricing on the sorts of things that we need to do, like redoing a whole bunch of sewer lines at a mobile home park, we had to build our own construction company to do it.
Okay.
Not at all what I planned on doing when I got into this space, but
yeah, I know. With us, Drew keeps wanting to do, our own management and stuff, but we don't have enough units to do that. So we're kind of like doing like a little bit of VA, and we're still managing. We still have third party and stuff, and we're kind of all over the place. We got 2 different areas in California and also one in Tennessee, right? So we're trying to consolidate and do a bunch of stuff. My question though for you is, so taking out of this deal and looking at the overall picture, now, do you guys, how you structure the deal? Is it a 60-40 LP GP split, and then you own portion of the GP? How does that work? What do you own all of the GP, or is it you and your buddy still, Chinese buddy?
Yeah, so it's just me at this point as far as Saratoga Group, and we we own the GP. Were you asking also about kind of the splits with investors?
Yeah.
Or okay,
Yeah.
It depends a little bit on kind of the deal.
Yeah.
We're trying to deliver to our investors something in the mid-teens. I would say a typical structure is a 7 pref and then a 70 to investors, 30 to Saratoga. Once we hit a 14 to investors, then we go 50-50.
Okay, and then the Saratoga is just you, or do you have more people in it? Like employees get a little bit of chunk of the equity, or no?
Yeah, no. We have, yes, definitely a portion of that is going to our key people at the company as well. Yeah.
Yeah, that's cool, man. That's awesome.
Yeah.
Yeah. So you kind of like split it off, like half of the equity goes to like people who work for you for long terms. And how do you incentivize that? Like, do you tell, like, if you work for 5 years, you kind of get cut in, or like, how does that work?
So it's basically, at this point, it's just kind of key people. So our CFO, our CTO heads all of our big CapEx projects, our head of HR, COO, and then a couple other people that are pretty critical to the business. So it's not, we want to get to where we have something for employees, and we've looked at that a little bit. It's relatively complicated, and so we just haven't taken the time to do it. But we are very, for employees, we have a lot of kind of bonus opportunities. So that's kind of, for them, I think, a little more meaningful because it's pretty immediate. Like, hey, you go move in a person to this property, like, here's your $500 bonus. You know what I mean?
Right.
That sort of thing. So we set up a lot of bonus incentives. So we're very much, we love that aspect of kind of HR, is like building reward systems that are good for the company and good for the employee. So.
Yeah, I do find that, once you start talking shop about equity ownership and all those things, you need to have certain level of mindset to kind of get to that game. For example, Drew and I own the company, right? 50-50. And, we've been in this game for 6 years. If you ask Drew, how much money have you made in 6 years? It'll be like $0, right? But equity wise, I mean, we're talking hundreds and hundreds of thousands of dollars, right? So, but you need to find people like kind of like who understand that. Like, if you don't, then that's not going to be a good fit, because it's easy to just give them the cash bonus.
Yeah, exactly. That's, I guess in MBA school, we called it expectancy theory, but we've kind of tried, and to your point, we've tried that with some of our, community managers, employees, where it's a little more long-term rewards. That doesn't actually work very well.
Yeah, they don't.
To your point. So we've decided, okay, look, here's what you have to do. Here's the bonuses that get paid out in your next paycheck. That has moved the needle.
Yep.
Whereas strategic, like I said, the COO or what, like, for them, they're like, well, no, we see what we're building here. We see the value of kind of the enterprise. And so for them, having a piece of that is very, very meaningful.
Yeah, I find something that's helped to separate, ourselves from the majority of our peers, say 5-6 years ago before we started, is that notion of being okay with delayed gratification, being okay with, just saving it, even when we sell a property, put it back into the next property, and only pay down a little bit of maybe any kind of debts or past labors that need to be caught up. And that's been, basically one of the key drivers of how we scaled so fast. Was we just, kept it moving and pumped it right back in and just said, no, I don't need the Rolex. I don't need the Porsche. Well, I think Vince would look good in a Porsche. I'm pushing that one still, maybe next year. But yeah, that notion of being able to just to keep that future in mind. For me, I've kind of gotten to a point now where I am at that point where I've built all these things. Somebody was asking me, they're like, so you're kind of just able to just travel and go and run these companies. And And they were just kind of like breaking down what my lifestyle is. And I was like, yes. So you have no kids, no dogs. Now it's a whole separate conversation. I was like, yes, I literally split with my last girl. One of the main reasons is because we had all this conversation. She grew up very wealthy and she's traveled the world. I grew up poor, really poor. I've seen very little of so that's my thing now. Like I just got back from Mexico. I'm leaving on Wednesday. I have to make this all about me, but that was all chess moves. That was all pieces of this puzzle that I put together that I'm now able to execute on. And people don't understand what's happening. They're like, so you're on vacation again? I'm like, no. Like I'm still working. Like I'm going to be flipping up my laptop in Nashville. I'm going to be working. I'm going to be walking our properties. I like real estate. I like to get there and touch it, touch the walls, meet the tenants, take the realtor who's, by the way, Vicky's the best. If you ever want to get into that Nashville market, she's your gal. Go take her to a steak dinner, catch up. How you doing? How's life? That thing, it goes a long way. And I just personally love it anyway. But relationships for sure has been one of the main drivers. And that's why I look forward to going up there. I'm going to have fun. I'm going to enjoy Broadway a little bit or whatever. But I'm also going to try to like just pay it forward a little bit and give back and shake hands with vendors and look at the next area that we want to get into. And so I built this lifestyle, all these little moves on purpose with intention because of this notion of just like delayed gratification. It's all for that freedom.
So important. Yeah. And in the Instagram world, it's like nobody delays gratification. It's all about now. You know what I mean?
Yep.
I'm such a believer in that principle. Yeah.
And so the reason why I kind of got on that soapbox a little bit about me is I always like to know the why. So what was your why? How did you, because it takes a lot of work. Like, there's so much under the hood of Sam that the audience does not have any idea. Unless you've been doing this for, 15 years investing in real estate, there's so many challenges of character, of finance, there's so many moments where you consider just quitting. We definitely have those early days had those talks where like, man, we should just get out. Yeah. And so what was your why that kept you driving through?
I wish I had a good answer. But I have reflected on it. I don't feel like at the time there was something really driving me that I could understand well. But as I look back, I've realized I really am a much better employer than I am an employee. And I don't think I really recognize that about myself, but my good buddy, he's been self-employed his whole life, right? I spent, almost 15 years in technology before going to real estate, working for somebody else. But he says to me, he's like, Sam, you realize you're unemployable now. Like nobody will hire you. I'm like, thanks a lot, man. which is, but it's true because I love being able to hire other people to create a company with a vision that's mine. And just that creation is something I get a lot of satisfaction out of. So I don't think I really understood that like during the process. But now that I reflect and look back, I realize that was it. I wasn't really happy working for somebody else. And that's not true for everybody. I don't know why I was that way, maybe, or you guys are both that way and other people aren't. But for some reason, entrepreneurs, they thrive when they're working for themselves and building something. And they just aren't very good employees, to be totally brutally honest.
Correct.
I wasn't terrible, but it wasn't my jam. I didn't thrive there. So
I interviewed terribly. I'm almost never in my whole track record of being an employee, which has been a while now since I've been a W-2. I never got a job unless it was like a friend referral. And I can sit there and I can, have the niceties and have, I was a straight A student and I can back it up. But for some reason, I don't know what it is. I just don't interview well. And then when I get in, I'm kind of challenging leadership a lot, not in a confronting way, just like I have ideas. And that was my journey. And I kind of realized like, I can't do this. I'd rather be taking all the risks and therefore the rewards, and maybe working the 16-hour days when you have a new startup, such as I'm sure you did with Saratoga Group. rather than cashing in a paycheck, taking orders, begging for vacation time, and, you know, even hoping you get the job, which I rarely did anyway. So.
Yeah. Totally relate to that. Yeah.
So tell me, if you would, I kind of want to start to wrap up a little bit. What makes your company, the Saratoga Group, different? Like, what are you guys? What's your thing? Let's talk about that.
Yeah, I would say that the main differentiator between us and others in our industry, and by the way, it's so cool. Like in our industry, we're all friends. Like we go to a conference, and it's not like we love going to dinner together, hanging out, talking shop. I mean, it's really an awesome fraternity. Like it's been so fun and so surprising in a way. But I'd say the thing that we do very differently than our peers is we have this ability to, because of the vertical integration, to basically take on properties and challenges that other groups are like, we're definitely not doing that. I mean, I'll give you an example. So I was traveling this last week. I was up in Indiana and Kentucky. We have one park in Indiana. We have two in Louisville, Kentucky. But I was going out there also to see a community that another operator owns. And they got a hold of us and said, look, we're having these issues. We don't know anybody that can handle or solve this except you guys. We heard about, and they kind of talked about this project that they had heard about. And the issue is this community, also built on a lake, has failing septic systems, and there's raw sewage getting into the lake from their community. They've got problems from the EPA. I mean, it's a hairy sort of situation. But we've done these kind of. I mean, we bought a property in Illinois, and the EPA was involved there, and the district attorney and the attorney. I'm sorry, not district. The attorney general for Illinois. And that was that they had poisoned wells there, and we got in there, and it took 2 years. We got hooked up to city water, and did that whole project ourselves. So we've done other things like that, and we've got the crews and the expertise, I'd say, in the team to kind of handle that sort of thing. So that's brought opportunity our way that, a lot of times if you're talking about real estate, it's like, okay, well, you got to be the highest bidder. And it's like, I don't love that situation, right? It's like, I don't want to pay more than the next guy's willing to pay necessarily. In this case, it's like, well, there's no other bidders. It's like, we are the only ones that they approached about this. And
so you're deep creative problem solvers on a very deep level. Basically, you're able to create a lot of value by problem solving these communities and bringing these communities up. Yeah, that sounds like shit work, if I can be so blunt. The dad jokes are coming. But yeah, that's insane. Like that's like, I don't even want to go there too deep, but like that's wild to me. It's can I quickly just ask a question?
Yeah.
Like vertically integrated company you have, are you just like moving some of your like team out to these new communities to build them up, putting them up in like Airbnbs, hotels, 6-month contract? We're just going to be hitting it hard for this timeline, and then they're into the next community. How does that work?
Yeah, that's right. One huge advantage for us is we go into so right now we have a crew in Kansas City, a crew in Springfield, Illinois. Our main crew is in Greenville, North Carolina, doing this RV project. Another single guy. So he's rehabbing homes for us. He's down in Florence, Alabama. So we've got those are our crews. And yeah, what we do is we have them. We actually do have a couple RVs. So sometimes they're using the RVs, but otherwise they are. We're putting them up in one of the homes that we have.
Oh, smart.
In those different areas, and then they're working at that location for 3 months or 6 months or whatever.
Nice.
So we have the next project and we move them to the next project.
Got it. Yeah. I figured that. But yeah, that's finding those high level people, those rock stars, if you will, is like the hardest thing. So it sounds like you find them, treat them well, keep them working, and utilize them to be your key players, as it were. So it sounds like.
That's true. Yeah. Like you said, it's all about the people. I mean, we have we basically have one really key guy on the construction side. If we didn't have him, honestly, we wouldn't have that company. But he's the one that can go, like he's done these huge sewer plants, and he has this experience. I don't have. I mean, I'm an engineer by background, but I've never done that. And
Right.
So having him on the team, that gives us the ability to do that sort of stuff.
Love it. I've kind of diverted a little bit back from numbers, and Vince, I'm sure, is kind of dying on hearing about some of the returns or potential returns of this most recent deal. Vince, you want to?
No, I think we're good on the numbers side of things. So you improve it, and do you? But I did have a question. Do you see that for compared to an apartment building or single family home, that the management side of mobile home parks is a little bit more intensive? Is that why the higher cap rate?
So there's kind of this dichotomy. It's way more intensive when you're turning it around and filling it up and all that. But once you've got a community full and stabilized, it's actually much easier to manage. So I'll give you an idea. Think about this. If you've got virtually full, 95 to 100% occupied mobile home community, they all own their own homes. What are you taking care of? Well, the streets, the grass, maybe if there's any kind of mainline water or sewer problems or electrical problems. But as far as the homes themselves, if the toilet leaks or they need new light bulbs or, a myriad of other things, it's their home. That's on them. So the hard part is getting to that. But any community that we've gotten there, it is a dream. So that's the reason we have 106 parks. We sold one.
Wow.
And there's one, well, that was in California. That's the only reason we sold it. That's the only reason we sold it. And we'll probably sell a couple here or there, maybe strategically, but for the most part, our plan is we buy these communities, we fix them, we fill them, and then we just keep them running, and we operate them, and we, occasionally have to do a little bit, maybe a major item here or there, but for the most part, they become very easy to manage.
You're probably one of the bigger ones in mobile home parks, right? In the US. I mean, if you have so many.
Yeah, I mean, it depends what you mean by bigger. I mean, there's definitely easily 25 or 30 groups that are bigger than us.
Yeah. Okay.
Yeah. So.
Have you come into contact with Brandon Turner's group, or do you guys have a bit on the same properties too? Or
yeah, a little bit. Yeah, for sure.
I forget. What is this company called? Not Better Tribe, something else.
It's Open Door Capital.
Open Door Capital, yeah. Nice.
Yeah.
He went hard into the mobile home.
Yeah, he went from single family to mobile home.
Yep.
Yeah, he did. Yeah, they're definitely very active.
That's cool, man. I usually end with what do you know for industry veterans like you? What do you think of the economy, and you think housing? How's it looking? You think people always need affordable housing? I mean, you can't even build a new affordable housing to make money, so there's always demand for it. What do you think?
So I mentioned I just was on a road trip this past week, Indiana, Kentucky. I had a ton of time to listen to podcasts. Mm-hmm. And I don't know if it's healthy or not, because I end up listening to a whole bunch of them, like on the economy and all the reasons that like we're in for a rude reckoning here. Yeah. And I think we do have a lot of issues that we need to sort through there. And so I'll like get done with listen to 3 or 4 hours. I'm like, all right, gotta buy gold. And it's like, hold on, the world's not burning down, right? So I am concerned. I mean, if you think like over a third of our budget as a federal government is now interest expense on all the debt we have. Like, think about that. If it was you or me or any company, we would be bankrupt in no time. Like, because how do you get out?
This company can print their own money. Boom.
Exactly.
Which is a whole different set of issues.
That's right. Right. And so they're doing that. And then we got this inflation problem, right? It's how do you solve both of those? Mm-hmm. So I definitely think inflation is probably here for a lot longer than we think. But again, what is better than a short-term lease real estate where you can adjust your rents based on the market. In the meantime, you've got fixed debt that you're paying down with depreciating dollars. Like in an inflationary environment, there's not a better place to be than real estate. I hate it because I feel like this is it's making it harder and harder to be a middle-class American. And it's really despicable to me. It's widening the gap between the rich and the poor. But all that being said, as far as an investment, affordable housing, I think, is in a very good spot.
Yeah, very insulated that way, And I'd say just advice for anyone listening, of course, it's a real estate podcast, but with that, the moral of that is buy real estate, and it's a weird thing to benefit from inflation, things that typically your uncle would complain about at the Thanksgiving table. But when you own real estate, you're on the side that actually benefits from that.
It's true. Yeah.
Do you even raise money anymore, or do you just have enough funds in your funds so you just buy it with cash and don't even go to banks for these deals?
We didn't raise money for the last deal, but we closed a portfolio in Kansas City last year, and we raised capital for that. And we're now it's starting to get interesting on the buy side. It's been a little sparse for a while. So we anticipate probably raising some money again, maybe in the second half of the year.
Okay. And with these, with these cap rates, you're talking 7, 6, 8, whatever, with the interest rates staying above that. So, you're borrowing money and you're losing money on it, right? Till you fix it up. Is that correct?
Well, yeah. I mean, so we're not interested in any negative leverage situations where you're paying more for your debt than you're getting on your income.
Yeah.
So this deal that we just closed, I realized that what I didn't include, and I don't want to get too nitty gritty on this, but with that park there was also a number of park owned homes, and those will rent out for $300 or $400 a month. That doesn't end up showing up, like we don't put a cap rate on that because it's a very depreciating type asset. But it does create cash flow in the interim. So our real cap rate in terms of like when you look at debt covers and that sort of thing, it's probably like 11 or 12%. Anyway, that being said, yeah. So we're not, if we're buying a deal, our debt's probably going to be 8 to 8.5 right now. Like that's what it's costing us for this sort of debt that we get on these mobile home parks. So that means whatever we're buying has to have that or higher in order for it to be something that we're going to buy.
Yeah, that's crazy, man. Yeah, I mean, at that point, you could just raise money and not even ask the banks for money, right? That's cool, man. That's all from me. Drew, do you have any final questions?
No, just would love to plug anything that you'd like to promote. Is there a book that I can get from you? Can I give you $1 million and you get me some nice returns? How does that work?
So, yeah, I would say just would love. I just love having conversations and connecting with people. So probably easiest to find me on LinkedIn, just /Sam Hales. But you can look up Saratoga Group. Our page there is relatively active as well. And I'm also sam@saratogagroup.com. So
awesome. We'll tag all that in the show notes. Thanks for your time, Sam. Appreciate you, man. You're inspiring and been very enlightening, especially for me in terms of how the game works in the mobile home game. So thank you for that.
Awesome. Yeah. Thank you guys. Yeah. Enjoying the conversation.
Thanks, Sam. That was cool.
I don't know about you, but I definitely like to see 5-star reviews on any service or any product before I purchase. Please take a second to leave us a 5-star review, whether you're listening to it on Apple, iTunes, or Spotify, or whatever platform. Take a second, goes a long way, helps us a lot to grow the channel, and thanks for listening.